On Friday morning, the U.S. government released a jobs report that economists weren't remotely prepared for. Not a slowdown, not a miss, an actual outright loss of jobs, the first negative print in months against a forecast that called for as many as 83,000 new jobs added. Within hours, gold surged to its highest level in roughly 2 months, above $4,300 an ounce, and silver broke past $63, a 6-week high. That's not a coincidence, and it's not the whole story either. If you own gold or silver, I want to walk you through exactly what happened Friday, why the reaction was so immediate, and the important nuance almost every headline is leaving out, because this report is more complicated than jobs bad, metals good. By the end of this video, you'll understand the real mechanics behind Friday's move, what's misleading about the headline number, and what's been quietly building underneath gold and silver even before this report landed. Stay with me because there's more happening here than one Friday morning number. Section 1. What actually happened Friday? Let's start with the number itself because it's worth sitting with. Non-farm payrolls fell by 23,000 in July, according to the Bureau of Labor Statistics. Economists surveyed by Dow Jones had expected an increase of roughly 83,000 jobs. That's not a small miss, that's a swing of over 100,000 jobs relative to expectations, in the wrong direction. And it got worse from there. The BLS also revised down May and June by a combined 103,000 jobs. May's total was cut from 129,000 down to just 63,000. June's was cut from 57,000 down to a mere 20,000. 3 straight months now showing a labor market meaningfully weaker than what was originally reported. The unemployment rate, meanwhile, actually ticked down slightly, from 4.2% to 4.1%. On the surface, that sounds like good news sitting next to a bad headline number, but here's the catch. Economists who dug into the details noted the drop reflects a shrinking labor force, meaning people leaving the job market entirely, rather than more people successfully finding work. That's a very different story than the headline suggests. Wage growth told a similarly soft story. Average hourly earnings rose just 3.2% over the past year, the slowest pace since May of 2021. Markets reacted immediately. The dollar fell sharply. Treasury yields dropped as investors priced in a lower probability of the Federal Reserve raising rates in September, and in some cases increased bets on an eventual cut. And gold and silver, both of which pay no yield and become relatively more attractive when rates fall or rate hike odds fade, jumped within minutes of the release. Gold climbed toward $4,300, then continued higher into the following session, touching levels above $4,350, its best weekly close since January. Silver moved even more sharply in percentage terms, breaking above $63 for the first time in 6 weeks. Quick ask before we go further. If you want the honest, complete read on reports like this one, instead of just a scary headline, hit subscribe because we break these down the moment they land. And I want to know, did Friday's jobs number change how you're thinking about your gold or silver position, or were you already holding through the volatility? Tell me in the comments, I read every one. Now let's get into the nuance because this report is genuinely more complicated than the headline number makes it look. Section 2, the part of the report most headlines left out. Here's where I want to slow down because treating this as a simple jobs collapse story would be misleading you, and I'm not going to do that. The main reason the headline number came in negative was a loss of 53,000 government jobs, and a meaningful chunk of that traces to seasonal factors in local government education specifically, the kind of adjustment quirk that can get partially revised away in future reports. Private sector payrolls, by contrast, actually rose by 30,000 in July. That's not the picture of an economy in freefall. It's a labor market that's genuinely cooling, real, and worth taking seriously. But it's not the same thing as a sudden collapse, and conflating the two would be dishonest. There's also a fair, fully documented reading on the unemployment rate that deserves airtime. The decline to 4.1% wasn't purely a story of people giving up on job searches either. Labor force flow data indicates the July figure actually reflects a somewhat reduced rate of job loss, not a wave of discouraged workers abandoning the search entirely. Taken together, several economists have described this report not as a sudden crisis, but as an economy sitting in what one analyst called a rough equilibrium, weaker than the strong hiring pace of prior months, but not yet flashing outright recession signals. Why does this nuance matter for your gold and silver? Because the market's reaction Friday was real and immediate, driven by genuine repricing of Fed rate hike odds. But if next month's report or upcoming revisions show this was more noise than signal, that reaction could unwind just as quickly as it arrived. This is exactly the kind of single data point that moves markets hard in the short term without settling the longer-term question on its own. Section 3. What was already building underneath gold and silver. Here's the part of this story that didn't start Friday morning, and it's arguably more important than the jobs report itself. On the silver side, industrial demand has been quietly accelerating well before this week's data. Chinese imports of silver-bearing ores surged 62.5% year-over-year in June, reaching 219,000 tons, driven in large part by expanding solar panel and electricity grid production. That's not a Friday story. That's a months-long structural trend running independently of any single U.S. labor report. Over the trailing year, silver is up roughly 62%, meaningfully outpacing gold's roughly 26% gain over the same stretch, a gap that traces back to 6 consecutive years of a global supply deficit the Silver Institute has documented, not to any single week's headlines. On the gold side, central bank buying has continued to provide a steady structural floor. The Bank of Korea recently established a formal framework specifically to purchase gold from South Korean refiners, joining a broader wave of central banks, particularly across Asia, that have been accumulating gold as part of reserve diversification strategy. China's own institutional buyers have also continued adding to gold-backed positions, partly as a hedge against volatility in technology stocks. None of this required Friday's jobs report to happen. It was already underway. There's also a geopolitical thread worth mentioning honestly. Progress toward reopening the Strait of Hormuz and restoring Iranian energy exports has helped ease some of the oil-driven inflation pressure that had been weighing on rate cut expectations earlier this year. That progress remains incomplete and could reverse, but it's been running in parallel with Friday's labor data, adding another layer to why gold and silver have found support recently beyond the jobs number alone. I want to be straightforward about the limits of what Friday's report tells us, because overreacting to a single data release is exactly the mistake that costs people money in this market. 1 month of negative payrolls, even with downward revisions attached, does not confirm a recession is underway. The private sector actually added jobs. A meaningful share of the headline miss traces to a government sector seasonal quirk that could get partially revised away, and the Federal Reserve, which held rates steady just the week before this report on a split 9-3 vote, still has several officials on record favoring a rate hike in September if inflation doesn't ease, meaning this single report is unlikely to settle that debate on its own. Gold and silver's sharp move on Friday reflects real, immediate repricing of rate expectations, not a verdict on where the economy or these metals are guaranteed to go from here. At the same time, it would be equally dishonest to wave away 3 consecutive months of downwardly revised, weaker than expected job growth as pure noise. That's a genuine pattern worth watching, not a one-off fluke. The honest position sits in the middle. This report matters, it moved markets for real reasons, and it's also just one data point in a longer, still unfolding sequence that upcoming reports, including August jobs data and the Fed's September meeting, will help clarify. Here's what I want you to walk away with. Friday's jobs report showed the U.S. economy shed 23,000 jobs in July against expectations for a solid gain, with the prior 2 months revised down by a combined 103,000, a genuine and immediate catalyst that sent gold to a 2-month high above $4,300 and silver to a 6-week high above $63. But the headline number is more nuanced than it looks, driven substantially by a government sector seasonal factor, with private payrolls actually positive. And underneath Friday's move sits a structural story in both metals: silver's industrial demand surge and 6-year supply deficit, and gold's steady central bank accumulation that was already building well before this report landed and doesn't depend on any single month's labor data to keep mattering. I want to hear from you. Do you think Friday's number represents a real shift in the economic picture, or is it more noise than signal until we see how the revisions and August report shake out? Tell me honestly in the comments. I read every one, and it shapes what we cover next. If this gave you the full picture instead of just the scary headline, subscribe before you go, because we'll be tracking the revisions, the Fed's next moves, and what it all means for your gold and your silver.